So portability can play a role in your estate plan, and here to talk with me about that is Philip Hertzberg from Team Hewins. Philip, welcome.
Pleasure to be speaking with you, Bob, on this important topic.
As always, kick us off. Where to begin?
So portability, as you mentioned, which was established as permanent in 2012, can play an integral role in helping you and your spouse avoid or reduce estate and income taxes. And it's hard to believe, but the federal gift and estate tax exclusion as of 2022 is about $12 million per individual or 24 million per married couples. And it's going to shoot up in 2023 to 12.92 million per individual and 25.84 million for married couples. So what may this mean to you? Well, this is for individuals and families who have sizable wealth. Gifts in excess of the exemptions are subject to the estate or gift tax at a 40% rate. So a married couple in 2022 should be able to collectively give 24 million or so during their life or at death to their children or other intended non-spousal beneficiaries without incurring estate or gift tax. Important to note here, portability is only available to married couples. It is a way of transferring the amount of the gift and estate tax exemption that a deceased spouse did not use to the surviving spouse. And a married couple can choose between portability first and or a bypass trust second to effectively use both of their applicable exclusions to protect their family from estate taxes. So the bottom line here is that a married couple can leverage the federal exemption portability provision to shield as much as 24 million or so of net worth in 2022. Now, caveat here is that the portability option applies when the deceased spouse's taxable estate is less than his or her remaining estate tax exclusion. So this planning occurs when the individual's remaining estate is less than the exclusion or when part or all of the individual's assets pass to the surviving spouse or charity, reducing the taxable estate to less than the exclusion amount.
So do we need to know anything about what would occur prior to 2011?
Sure. Well, to give you some background here, and this is in regards to the Credit Shelter Trust in 2011, still being used now. But prior to 2011, the first to die spouse needed to use such spouse's exemptions in its entirety during life or at death to ensure it wasn't wasted. And the exemption was frequently used by fully funding what's called a credit shelter trust, or also known as a bypass or family trust, under the first to die's will or revocable living trust. So assets placed in the trust are generally held apart from the estate of the surviving spouse so that they may pass tax-free to the remaining beneficiaries at the death of the surviving spouse.
Right. So this year in July of 2022, the IRS extended the late portability election?
Yeah, and the IRS last July 8th issued a new revenue procedure that enables a deceased person's estate to elect portability of their unused estate and gift tax exemption for up to 5 years after death. So you may be able to file an IRS Form 706, the United States Estate and GST tax return. GST is gift generation skipping transfer tax, to transfer unused estate tax exclusion to yourself if your spouse passed away less than 5 years ago. Takeaway here is that portability has enabled more flexible estate planning, where the first to die spouse's exemption is not necessarily wasted, even if all or most assets passed outright to the surviving spouse or in a marital trust without using any exemption.
So you have some guidance on how these changes to portability can impact our readers and viewers?
Yeah, absolutely. I mean, it's important here if you're going to be thinking about using portability, just know that you do not automatically inherit your spouse's unused exemption. And to claim the benefit of the portability of the exemption, you have to file IRS Form 706 estate tax return to make that election to add the unused exemption to your own. And this is even if the estate does not owe a tax. So previously, before you had up to 5 years, this return had to be filed within 2 years of a person's date of death. And that assumes that the 706, the estate tax form, was not required sooner. So the reason the IRS decided to extend filing time is that many estates kept missing this important window.
So you have a planning insight with respect to this?
Sure. So just think about it in terms of the numbers here. So let's say your spouse's estate in year 2022 was worth $4 million. Dollars. That would leave an unused exemption of about a little over 8 million that you could add to your own $12 million exemption should you ever need it. So you must file the estate tax return for your spouse and complete the section of the Form 706 currently titled Portability of the C spouse's unused exclusion with a computationist amount.
So there are some other estate planning techniques to follow instead of over solely relying on portability.
Yeah, absolutely. And again, the use of a credit shelter trust, which was again used prior to year 2011, and other traditional estate planning techniques may be more appropriate for some folks than relying on portabilities. So you have to look at both the tax and non-tax factors and speak with your professionals about what should be considered when determining when portability is suitable for you. It's important to note, a few things when you're comparing portability and credit shelter. And Bob, I mean, we can talk about various pros and cons.
Yeah, let's do that.
Absolutely. So, in looking at maybe why one would the advantages of choosing a credit shelter trust over portability here, it's important to be aware that portability only carries over the exclusion in effect at the date of death. The credit shelter trust exempts assets and any appreciation on them from estate taxes. So, all the growth that you're going to get in the value of assets in a credit shelter trust bypasses a surviving spouse's estate and won't be subject to federal estate and possibly state taxes at the surviving spouse's death. And the other important points here, as far as credit shelter trust as compared to portability and why one may choose a credit shelter trust, is that you have to be mindful that portability is not available in most states, that where one has their own state estate taxes, and that portability does not apply to the generation skipping trust, the GST tax exemption. So if a married couple wishes to create a dynasty trust for the benefit of their heirs, the portability election should not be made, as it can result in the loss of a deceased spouse's unused generation skipping trust tax exemption. Another potential advantage of utilizing a credit shelter trust over electing portability is that the deceased spouse's unused exclusion amount, it could be lost if the surviving spouse is likely to remarry. So the first spouse to die has control over where the assets remaining in the trust are distributed after the surviving spouse's death, rather than depending on the surviving spouse to carry out the desires of the first spouse to die. And the take home message here, should the surviving spouse remarry, is that the predeceasing spouse's assets will pass to the heirs, the spouse intended to benefit, rather than to the new spouse or to the children of this new marriage.
Right. And there are now some advantages to electing portability.
Absolutely, Bob. So there are a lot of features of portability as to why one would want to select this over maybe utilizing a credit shelter trust or other traditional modes of estate planning. And here are the two main reasons. First, portability may allow for potentially better income tax planning if it's important for you to receive another step up in basis on the surviving spouse's death. And secondly, for families with sizable wealth, the ability to claim the deceased spouse's unused exemption through filing an estate tax return is now extended, which is now extended for up to 5 years after death. It could result in substantial tax savings. So first, to elaborate a little bit more about receiving another step up in basis on the surviving spouse's death, assets that are included in the surviving spouse's estate at death will receive a step up in income basis for a second time, while assets in a bypass trust are only stepped up once at the death of a first spouse. So the second main reason why one would want to elect portability is that, again, it could result in substantial tax savings. And under current law, it's important to be aware as everybody is following this. The higher 2022 exemptions, which is 12 million per individual with inflation adjustments through 2025, will sunset or expire on December 31st, 2025. So consequently, the exemption will be reduced by about half to an inflation adjusted 6 million for an individual passing away in the year 2026 or later. So even though many families right now do not have an estate tax problem under the current law with these elevated exemptions, they may very well pay estate tax if the second spouse dies after the exemptions are cut in half. In this scenario, claiming the first to die's spouse's deceased spousal unused exclusion could ensure that you owe no estate tax, or maybe at a minimum, you save significant taxes on your money.
So what about portability benefits for those with retirement accounts and substantial assets?
Yeah, so it's worthwhile. Everybody has a different mix of investment assets or other properties, personal real estate. So if you're thinking about electing portability, for example, a lot of spouses, let's say um, one owns a $10 million retirement plan and IRA assets, while the other spouse has 400,000 and cannot fund a credit shelter trust. Well, since ownership of the retirement accounts with over $10 million in assets cannot be transferred or split between two spouses while living, a spouse can be designated as the primary beneficiary of these retirement assets and use portability as a preferred approach for efficient income tax deferral. So portability, a great advantage of this is that it preserves the optimal stretch potential for IRA assets for surviving spouses who can then facilitate rollovers to their own IRAs.
So, Philip, we've covered a lot of ground. Anything we missed?
Yeah, it is important to know that filing a Form 706 with your estate tax attorney or your qualified tax professional can cost anywhere from 5,000 to 20,000 or so. So while it may not be, so even though it is pricey, it's not to your benefit to skip filing Form 706 for estate taxes, especially if you're a high net worth family who owns interest in harder to value assets, such as certain types of businesses or real estate. So you may make the mistake of not filing an estate tax return since you think your first spouse's wealth is below the threshold. But just be aware that if the IRS questions the estate valuation letter, it may block the second spouse from fully leveraging all the benefits of portability. And finally, Bob, I can't underscore the importance enough of seeking the counsel of a qualified estate planning attorney in tandem with the guidance of a certified financial planner professional to help you decide if you should file Form 706 for the estate taxes.
Philip, I can't thank you enough for sharing your knowledge and wisdom about this very important topic with our readers and viewers. It's greatly appreciated.
My pleasure, Bob.